Welcome to another Straight Up Tuesday tip. I'm 𝗤𝗁𝗁𝗁𝗁. With me as always is 𝗬𝘃𝗲𝗁𝗁. And with us, probably approaching almost the 10-time champion here, Farella. Perry, welcome back to the show.
Thanks, Tom.
We're excited to have you, and we've been waiting for this episode. I know you've been talking about this new product that had been coming out. We've been talking about it, and it's here. And now we want to let our listeners know about it. So I'll give a little preface for everyone. Perry has a 2 to 4 unit fix and flip renovation financing option that was not previously available in the market. It's designed as a portfolio loan program. It's an alternative to hard money lenders who may typically have, whether it be higher rates or need you to have X amount of experience. An investor has no requirements to ever occupy the property. So this is for both either a house hacker or if you're just looking at a 2 to 4 unit building that you want to hold it as an investment and you need some renovation done on the front end, this is a potential answer for you. So that's the little teaser. Perry, give us a little bit more meat of this. Give us the 30-second synopsis. What are we talking about here?
Yeah, really quickly, it's a hybrid kind of loan because it has some characteristics of conventional loans and hard money loans. So it's interest only for the first 9 to 12 months in payments. It's 25% down payment, meaning add the sale price to the renovation dollars you want, multiply that by 25%, that's your down payment. So it's a 75% mortgage. Based on credit scores, interest rates will vary. Interest only for the first 9 to 12 months. And you can count rents to qualify, much like a conventional loan. You don't have to have fix and flip experience. If you're a newbie, that's fine. The loan is a balloon mortgage. It's valid for up to 12 months. Then you fix the property, sell it, make your profit, pay off the loan, do the next one. Or if you want, you can keep the property, refinance it to a conventional 30-year fixed rate loan.
Got it. So look, there's a lot to unpack there, but one thing that you said that might scare someone who hasn't done the renovation before, similar to some of the acquisition loans, oh my God, it balloons in 9 months, 12 months. What happens? Like, am I putting myself up for risk there? Like, that's probably, for someone who hasn't been through that process before, the first thing going through their mind. So talk to us a little bit about that.
Yeah, the loan is a portfolio loan. That means it's never going to be sold into the financial markets, just kept in the vault here at the bank at First Community Mortgage Bank. We're owned by a mortgage bank, so we're offering this private portfolio loan with these specific custom terms. So the bank would like their money back within 12 months. So we have to be very careful to time the construction and so forth to make sure it's done in 12 months. There are penalties for delivering it late. The penalties are 1% for each month, i.e. 1% of that loan amount. So we don't want to go past 12 months, ideally not even past 9 months. So we have to be really, really tight on our construction deadlines and so forth.
Got it. All right, very good for everyone to know. So talk to us a little about, you said rents, like let's say I'm buying a building, it's a 3-unit building. It's in a nice area. It needs, $200K of work or whatever the number is, and I'm getting this thing delivered to me vacant. How are you coming up with that ARV? Are you allowed to use the future rents, right? Like, just talk to us a little about like the structuring there, because that's probably ambiguous to some of our listeners who haven't been through this before.
Yeah, we're talking about 2 things. We're going to do an after renovated value appraisal based upon the improvements to be made and the costs. So we'll know what the building is going to be worth after it's renovated, hopefully more than what you're paying for it and putting into it. We'll also ask the appraiser to give us after renovated value rents, meaning that of that type of renovated apartment in that location with that square footage, what are rents in that area going for that are seen on the MLS today? And so those are the 2 components that go into an appraisal for this product.
And those rents then, like debt to income ratio, am I getting credit for those?
Yeah, that's the great thing about this product that's different from hard money loans. They usually don't give you credit for the future rents on apartments that are still vacant that haven't even been rented yet. So we're doing rental projections. So let's say an apartment is projected by an appraiser to rent for $2,000 a month. We're going to give you 75% of that, i.e. $1,500 as extra income to qualify for the size mortgage that you need. Hard money loans typically would not work that way. This is more of a conventional aspect. That's why I said it was more of a hybrid loan at the start.
All right. And then going along those lines, because there's probably some listeners familiar with the 203K loan, right? So what I'm hearing from you that might be different or an advantage to this product, and I don't want to take words out of your mouth, so correct everything I'm about to say here, but we don't have to worry about a self-sufficiency test like FHA would have, which is big, right? That kills a lot of deals on the north side of Chicago because the values of the building are so high and rates are so high right now. We're getting credit for the rents, the debt to income ratio, and it sounds like we don't need that HUD consultant as well. It's just a smoother transition. You don't have to check that box also when you're doing your offer. You can say, you don't have to check the FHA box in case the seller has a negative stigma to that. Is that accurate? Like selling this against a 203K loan?
Yeah, it's all accurate. So there's no HUD consultants, no self-sufficiency test on 3 and 4 unit properties. It's for investors, as where FHA 2 or 3K is only for owner occupiers. So you can fix and flip all you want. There's no prepayment penalty. It's a balloon mortgage. Just pay the mortgage back within 12 months and go on and do the next one if you want.
How is the draw process? Is it going through Chicago Title? Is it going through your guys' private subcontractors? How does that work?
We keep the draw process in-house. We don't have to go through title companies. So there's a maximum of 6 draws during the construction time. And at closing, if you'd like, we'll give you up to 30% of your rental budget in a check to your contractor at closing day to get started.
That's big right there. Like that's one of the first times I've heard of that, or I've missed that detail with other lenders. Like that's huge.
So we want the projects done quickly, so we're willing to give money out directly to the contractors right at closing day.
That's awesome. So like, just for our listeners to understand that, and and having the draws in-house, that helps your liquidity tremendously, because you don't need the seed money to get the project going and then get that first draw, right? And then also, for those who haven't been through the process, like, man, when you go through the title company, you'll have like a 6-figure draw sitting there that you're waiting on because you don't have the gutter receipt, or just one little partial waiver out of like 25 that you spent and had these guys go and get notarized. And the man hours, like, it's like a legit position. It's something like I'm almost looking to hire someone to handle that process for me when I go to lenders that have like actual title companies involved, because it's messy. So then that takes longer and you have liquidity tied up there. So both those points, that makes this a lot simpler. Safer might not be the right word, but easier for someone looking to just get started and do their first rehab.
Yeah, ease of doing business. That definitely is a notch down from having to deal directly with a title company.
Yeah. So are there limits on this too? Like, can you go and take some giant rehab? Like, yeah, I'm going to buy, an expensive building and do like, what are some of the framework, I should say, that we have to work within?
Yeah, we're going to work within existing 2023 conventional loan limits. So this year, a 2-unit conventional loan limit is $929,850, 3-unit $1,123,900, and 4-unit $1,396,800. So we think that those are pretty generous loan limits because they parallel conventional loan limits. As loan limits go up every year, these loan limits will go up as well. But that facilitates the refinance afterward. If you elect to retain the property, you don't want to sell it, you want to keep it for the rent cash flow, then you can easily refi this balloon renovation loan into a traditional 30-year conventional mortgage.
Man, seems easy.
We're trying to make it easy, and we're trying to also put guardrails on. Another couple of guardrails would be, we want everybody to have 6 months of reserves based on the full principal, interest, tax, insurance payment. So you got to have 6 months reserves. Right now, our debt to income ratio is 35%, but because we're letting you use the future rents, that should be easier to meet the 35% debt to income ratio cap.
Man, Tom, you and me were at dinner last night talking about the topic of lenders need to get deals done still, even the higher interest rate. There's less people borrowing money. So banks like Perry's here, they have to be creative on making the ease of doing business or different programs or different ways of getting the loans done or people coming to them. So this is kind of a sign of that.
Yeah, flexible terms, right? Like, how can, or working with the investor, this is what you want to accomplish. Cool. We now have a product that'll get it done for you.
Yep.
Right? Because in the space, if you are not owner occupying a 2 to 4 unit, a lot of portfolio lenders, quote unquote, like a lot of banks don't want to do anything under, a 7-figure loan, right? So like that was like a very tough spot in the market. And I've been there, right? You don't have a lot of options if you're not owner occupying. And then the bigger boys don't want to come down and play with you because it's, a $600K loan or whatever. There weren't a lot of options there, especially if you want to do rehab on the front end. Like, it gets very limited. Perry, anything else we should know about this?
Contingency reserve. We want to protect everybody, so we always do at least a 10% contingency reserve off the rehab budget. So if your rehab budget was $100,000, we're going to put in an extra 10% or $10,000 just in case of unforeseen problems that occur when you start opening up the walls. If you don't use that extra 10%, it's subtracted from the principal that you owe at the end of the process.
That's good. Just in case when you use it, not if, usually.
You're going to use it.
Right. So that's great. But again, that's another good thing. You're putting some guardrails in there for people to not fall off the edge. So I that's actually probably really good for anybody that's using the product.
One last item would be a question on fees. Everybody wants to know about fees. So the fees are just a standard processing, underwriting, appraisal, plus a 1% origination fee. So we feel that we're priced competitively against hard money lenders that way.
Yeah, absolutely. So, well, cool. Perry, I know we'll link to it in the show notes, but real quick before we wrap here, how can people learn more about this product and about you?
They can get in my website, 𝗤𝗏𝗏𝗏𝗏renovation.com, and they can read more details about this loan and every other renovation loan there and contact me that way.
Got it. It's the number 2, right? Am I mistaken?
Yeah, the number 2, 𝗤𝗏𝗏𝗏𝗏renovation.com.
There we go. All right. Well, great. And we'll link to that in the show notes. Mark, you ready for a Chicago Fact?
Yeah, today's Chicago Fact, we're playing for Brandon D, who bought a t-shirt. So Brandon, thank you for supporting the Straight Up Chicago merch store. And today's sponsor is no one else other than Perry Farella from First Community Mortgage Bank. So Brandon, if myself or Perry gets this question right, you'll get a $50 gift card brought to you by Perry's Bank, First Community Mortgage Bank.
All right. So I'm about to read a book, Operation Family Secrets. We haven't had a good mob question here in a while, Mark. So let's go. So for those who don't know, Operation Family Secrets is an FBI investigation. It led to the indictment of 14 defendants, all affiliated with the Chicago outfit. One of the biggest FBI takedowns, basically crippled Chicago underground crime. The family involved in this, so it's a son who basically ratted on his dad, who was the boss, and his uncle, and then basically everyone else in the organization. The family last name is 𝗤𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏
That's easy.
Frankie Brees, Frank Calabrese Sr. gets taken down by his son.
Yeah.
Pitch for intimidation. The funny thing is, which I've learned from this is, they took over like a car wash or something because the guy didn't make payments. And then from there, that's where he got in trouble for intimidation, loan sharking, racketeering, all those softer things. Couldn't handle it. And so he turned over his dad for like all these different murders. Like this little crime turned into like taking down the whole organization.
Yeah, that book's good. It talks about Connie's Pizza, their involvement with that. It talks about Celebras, the 𝗬𝘃𝗲𝗀𝗃, where you always pay more money. Anyone that's over 35 remembers those commercials.
Yeah.
Like they extorted there. But great book. Yeah, no, I've listed all those books. All right, Brandon.
Nail it.
Brandon, you $50 gift card. Sorry, Perry, you didn't get a chance to answer that, but we got Brandon a $50 gift card brought to you by First Community Mortgage. So, Perry, thanks for coming back at the umpteenth time. It's awesome always having you. You always have great value to add to our listeners. Tom, thank you as always. Listeners, we'll see you Thursday.
Thanks all.